Hello, and thank you for joining us today. We will wait a few minutes to allow some additional attendees to join us. So please stand by. Hello once again. Thank you for joining us for today's webinar on cost segregation, maximizing tax savings through accelerated depreciation. For those of you who may not be familiar with Source Advisors, we have helped CPA firms and their clients maximize specialized federal and state tax incentives for more than 4 decades. We are headquartered in Fort Worth, Texas, where we collaborate with accounting firms throughout the country to bring R&D tax credit, cost segregation, LIFO, 179D, 45L, state and local tax, as well as property tax solutions to their clients. A few housekeeping items before we begin today. There will be 4 polling questions throughout the presentation. You will need to answer at least 3 of the polling questions and attend at least 50 minutes of the session as measured by the presentation software to qualify for CPE. CPE certificates will be emailed to you within 3 business days. Also, please utilize both the chat and Q&A functionality, which are located in the upper right-hand corner throughout the presentation. However, if you have a specific question for the speaker, please make certain to use the Q&A function so that we may answer them at the end of the presentation, with which there should be sufficient time. If not, we will make certain to catch up with you afterwards. Additionally, you can now download the PDF of this presentation. Finally, I'm happy to introduce our speaker today, who is John Gale. John is a CCSP and Technical Sales Director at Source Advisors. John has more than 8 years of direct cost segregation experience and is one of only 53 certified cost segregation professionals. His areas of expertise include fixed asset depreciation, tax research, business intelligence dashboarding. Combining his knowledge of accounting principles with quantitative reasoning, John has created substantial tax savings for clients in nearly every industry. With that, I will hand it over to you.
Thank you, Ann. Hi, everybody. I know it's everybody's favorite thing, CPE, early in the morning for some of you I know. Appreciate you joining me. You're actually a very fortunate audience. You're the first ones to see this slide deck. So I will do my best to make it entertaining for you as we get through it. As Ann said, this is a little bit about my background. I am a certified cost segregation professional. That's a distinction that you don't run into a lot of in this industry. And when we talk about quality cost segregation studies, that is something that you can kind of guarantee you'll get a quality cost segregation study if you look for that CCSP. That being said, let's go ahead and dive right in. Today we're going to cover, what is cost segregation? When does it apply? What's the financial impact of cost segregation? History, legal support, some of the tests that we use to qualify property. And then we're going to have a case study. We're going to look at something that was, my tax professor always used to say, this is the rule in tax and this is how it works, except for, there's always an exception because that's just how tax works. And we're going to look at finally a timeline for a typical study. And if we run out of time, I've got a bonus for you, but we'll see if that happens. I don't think that's going to happen. So what is cost segregation study? I have a definition up here: a tax strategy that identifies and reclassifies personal property assets associated with the acquisition, construction, or renovation of real property. So what really is cost segregation? There's this idea that when you bought a building, typically what happens is we put it on our depreciation schedule as land and building. We make that allocation, but that's not really all you bought. You bought asphalt, you bought carpeting, you bought retention ponds, sidewalk. All those things have value, and all those things have a shorter life than 39 year. And so the point of cost segregation is to identify and value those assets so that we can move them into a shorter life, shorter depreciable life, sooner deductions, better near-term cash flow, net present value. That's what this all comes down to. And so when we think about a typical study, we think about whether it be an acquisition or new construction. We kind of think of these boxes here on the left. That we have the owner costs, we have general contractor costs, and then we have change orders. And those three like cost sources, if you will, come together to form all the things that really go into real property. And this is the CSI master format. This is a standard nomenclature. Again, standard numbering system. That's something you want to look for in a quality study. But Division 0 land, Division 2 site construction, so on and so forth, all the way down to Division 16 electrical. There is another version of this, but this is kind of the industry standard, the number 0 through 16 nomenclature. And then once we identify those buckets, and that's generally how it'll be listed on your main construction doc, your AIA doc, when you build something. Once we have those, we break those down a little bit further, right? So finishes might have carpet in it. It might have snap lock flooring. Your electrical system, it probably does include 1250 lighting. That's necessary for the normal operation and maintenance of your building. But it might also have a bunch of dedicated electricity for your equipment. It might have, your plumbing might have gas lines that are dedicated to a nitrous oxide for a dental facility. So the point in a cost segregation is we come in and we identify all those building components. We provide an allocation for them, we value them, and basically that's what your basis turns into, and that's what goes on your depreciation schedule. So we think about, when does it apply? And again, this comes back to what my tax professor always told us is it's always this until it's not, because that's what tax is. And so we like to say studies are limited to the last 5 to 7 years. I've also seen them go back 15 years, maybe even 20. It really just depends. If you've got a $40 million data center sitting on your depreciation schedule as 39 years, we should probably talk about it, even if it was 15 to 20 years ago. Those complicated buildings tend to draw a lot of benefit, especially in electricity, because you've got in a data center, you've got all those pieces of equipment running the server. In a manufacturing facility, you've got all that equipment drawing a specific load. I don't want to go too much into the electrical part of that, but the point being, there, especially with a high basis, we tend to be able to go back further than 5 to 7 years, and that would be called a look back study. So again, beyond the 5 to 7 years, we like to say 500,000 is a good starting point. A couple of years ago, we still were in 100% bonus. 250,000 was kind of a good starting point. And there's really no cap. I mean, you have a $500 million building, you definitely want to do a cost seg on that. And even today, especially in single family, because they tend to generate a higher benefit and have a fairly low cost compared to other buildings because they're fairly simple. But they have a lot of finishes. They have countertops, equipment, appliances. They have, lots of carpeting, snap lock flooring, that kind of stuff throughout. So if it's a single family home, we go a little lower than 500,000. But if you're on the fence, you can always reach out and get a free quote on those kind of things. So this really applies to anybody who owns a income producing property, whether that be no personal residences, obviously, but no churches. They don't pay taxes. I can't save them any money on their taxes. But anything else, any other type of building that generates income for you, storage facility, multifamily, anything you want. So, like I was saying, those complex buildings, though, these manufacturing facilities, these data centers, restaurants, those tend to have more complexity, more plumbing, more mechanical, more electrical. Those things tend to drive higher benefit, especially data centers. Data centers are a gem. So a lot of people, when we think about cost segregation, we think that it's just for new construction or it's for acquisitions, but it's better to think about this as a tool for the whole life cycle of your building. So of course, when you buy or build a building, yes, a cost segregation makes a lot of sense, especially to give you value for all those short life assets. But something that we overlook from time to time is the long life assets. And I'll get to that in just a second. But we have the tangible property regulations came into play a couple of years back, and we got the ability to finally define what repairs are and what they mean, and that de minimis safe harbor associated with those, whether it's a betterment, adaptation, or rehabilitation. So when you take that disposition, if you 5 years down the road after buying a building, let's say you replaced all the HVAC, you replaced the partition walls, you replaced the ceiling, you replaced the doors. So if you replaced all those things and we have a value for them, well, guess what? As a CPA, when it's time to write those things off, you have that value. It's right there on your cost segregation report. Now you know exactly how much to take off. And that flows right into a remodel. Your owners might want to remodel this building several years down the road. And again, you can go back and do a look back study to value those things, but you can't just swag it. You can't just say it's about 15% that we spent on this, or about 20% we spent on that. Because if that thing gets audited, the IRS is going to disqualify the whole thing. And in some cases, they don't want to let you have a cost segregation study after the fact. So it's really important to get those things done early on. And finally, it helps in a sale or a 1031, right? Because that allows us to determine our gain. That allows us to determine our exchange and excess basis when we buy that new property in the 1031 exchange. So really, cost segregation is not just for the acquisition of the new construction. It's better to think about this as a tool for the entire life cycle of the building. So the financial impact, and this may speak for itself a little bit here, but key benefits of the cost segregation, again, net present value. More write-offs today, better tax savings today. That keeps more money in our clients' pockets. They can do whatever they like with that. Some of them reinvested in that building. Some of them buy another building. Some of them put it, back in the operating company, wherever they end up needing that cash, especially, for these partnerships or, everyone likes cash. So pretty much anyone. And is it time for a question?
We can certainly ask one. Let me go to a poll. Let's start polling. All right. Which of the following is typically reclassified into a 5-year asset category? Roof shingles, asphalt paving, carpeting, or windows? You do not need to get this right. You just need to respond. So please answer now. We got about 100 people who've responded. We need a few more. I think we can move on.
I see a question just popped up. Would it be beneficial to do a study right before a sale? Yeah, it can be. It can be, especially when we talk about hotel ownership. Hotel owners are really big on these purchase price agreements. They want to know, they want to decide how much is FF&E and how much is other types of equipment. And so doing those studies can help with that. It can help with, if you've owned a building for 10 years and that 5-year property is fully depreciated, there's circumstances where you're not going to face recapture, and we can still get some of those deductions. We talk about those on a case-by-case basis, but it could certainly be worth exploring. I'll do one more. The threshold for single-family rental properties. Again, it's tax. There's always an exception, right? But like I was saying, lately I've been seeing it at about $250,000 for those single-family residential properties. Remember, it can't be personal use. It has to be income-producing property. But as long as that's the case, they're fairly simple buildings, so we keep the cost down on those, and we can handle a fairly low basis and still make it make sense for the client. Okay. I'm going to go ahead and move on. All right, so I guess maybe I jumped ahead there. And what types of stuff can be reclassified? 5-year, that's carpeting. Hopefully that's what everyone chose for the 5-year. But also decorative lighting, things that are purely aesthetic, not your primary lighting in a hallway, but maybe those drop lights in your kitchen, or the recess light that's just highlighting a pot or something decorative like that. Break room sinks and computer room HVAC. The HVAC is really tricky. It has a specific test that applies to it that allows us to take HVAC where it otherwise wouldn't be allowed to be taken. I'm going to get into that in a little bit though. And then for your 15-year, these are typically your land improvements, asphalt, landscaping, a retention pond like this guy. Has to be, it has to be man-made. Natural ponds and lakes don't qualify for this. But then we get qualified improvement property, and this was introduced by the PATH Act, but it didn't quite work at that time. But these are improvements that are made to an interior portion of a non-residential building after the building's placed in service. So not residential, not exterior, nothing structural. Okay, so and there's a question maybe you could look at. Just let me know if I need to stop.
No, please go ahead.
Okay. So the total potential percentage of reclassified property. Again, this, as I was saying, a lot of things affect this. It's a lot of times it's the complexity of the building. On the low end here, we tend to see warehouses. Warehouses are basically 4 walls, some windows, a door, and a roof. And that's basically it. And then maybe the owner moves some racking in there, but a lot of times that's an operating company, not the property company. And so a warehouse is really bare bones, but even those tend to make sense because they're kind of low cost for us to do compared to other buildings. And a lot of times they have some office space or they have enough land improvements to make them make sense. Then especially a distribution center, those things tend to have awesome parking lots from a cost perspective. And then down at the bottom, we see data center. Data centers are incredible. They have so much electricity that tends to be dedicated to, personal use, not personal use, to specific to that data equipment, manufacturing, all the electrical, sometimes plumbing that's dedicated to that equipment. So some of the other things that affect that, what type of finish did you use? Did you use that cheap VCT or did you use that expensive floating floor, that snap lock flooring? How big is your parking lot? Is it thick? Are you handling big heavy trucks on that thing? It might be a 10-inch thick concrete pad. That's going to be expensive. That's going to be expensive paving, or it might be a small residential with thin asphalt, or it might be gravel. So there's a couple other things that we say affect this, and I wish I could tell you which one's best. Well, I can tell you which one's best, but when you talk about ground up new construction or just an acquisition of an existing building, it's really hard to say. Ground up new construction could mean a vanilla shell for a building. It could mean you built 4 walls in a retail shopping center and you put your storefront windows in your door, but then when I walk in, the slab's not even complete because you're going to let that tenant build out their plumbing and their electric and then pour the slab on top of it. I've seen that plenty of times. Or maybe you fit out the entire building, anything in between. An acquisition tends to be pretty good because all those improvements are already in place. You're typically buying a lot of 1245 property in those. And the real gem, renovations and tenant improvements, right? QIP is amazing. Non-structural, non-residential interior improvements to a building previously placed in service. We get 15-year life, eligible for bonus. So you might see the assumptions here at the bottom. That's kind of what this chart's running off of. I'll say auto dealerships, these things tend to be all over the place. Some in previous years, we were seeing a slightly higher benefit than what we're seeing today, but every property is unique. The tax benefits are just something that you really can't swag this. Okay, we are going to move into a little bit more discussion on qualified improvement property. So treating QIP as 39-year property, some of you might remember the retail glitch, and I will talk about that a little more in a second, but you have to change it because that might be subject to a gain calculation, right? Again, these exterior items, structural items, those things aren't going to qualify as QIP. It has to be interior, non-structural type items. And personal property also not QIP. And why does the IRS care if I did all interior improvements? I know I didn't, change any structure. Why can't I just put the whole thing to QIP? Well, it's because recapture, right? 1245 recapture rules are less favorable than they are for QIP. And so we've seen where the IRS, where people have come in and tried to just put the whole thing to QIP, the IRS will then make you go and have a cost segregation study if you want to do that, where they're going to reclassify the entire thing. So it's really important to do those, especially on the larger, more complicated buildings, and especially on QIP if you're not really familiar with the rules. Again, the regs say we can't include enlargements. That has some nuance to it, right? So if I expand the footprint of the building, no, I can't. If I build another floor on top of the building, no, none of that's going to qualify for QIP. That's a true enlargement of the space. But let's say I have a 30-foot tall building, and maybe it's a warehouse, and then I build a second floor, or I build a mezzanine. Now I've increased the occupiable square footage, but I haven't increased the cubic volume. So that's not a true enlargement. And a lot of those improvements are probably going to qualify for QIP. Now, again, I think as CPAs, we probably know that a lot of states decouple from bonus or QIP, and that's something that we work through on a case-by-case basis. So, common misconceptions. This is only for large businesses. No, as we said, single-family homes qualify for this. Small taxpayers benefit. In fact, small taxpayers increasingly have been taking advantage of this as it's become more common, more mainstream. It's something that anyone with enough basis and real property can take advantage of. It's too expensive. That's absolutely not true. Our return on investment's usually greater than 10 to 1. Sometimes it's higher than 100 to 1. Especially, data centers. I've been looking at a couple data centers lately, and I'm just blown away every single time. It's risky. That's not true. This stuff is backed by tax law. It's commonly accepted. The IRS has their positions. We have our positions. A lot of these things have already been to court and decided it's well backed by tax law. As long as you have a quality study, again, common nomenclature, proper documentation, going out, actually visiting the site, taking those photos, taking those notes, reconciling it in an acceptable way, and whether it be engineering based from actual cost. Those are the things that make up a qualified study. I would strongly advise you to stay away from the fly-by-night firms, especially if they're saying we don't do site visits, or we can do it very cheap. They're probably not doing their due diligence, and you're going to give all those cost segregation, you're going to give all those deductions back when the time comes. Let's see.
How about another poll?
Yeah, go ahead.
All right, here we go. What is qualified improvement property, QIP? All exterior improvements to a building, interior improvements to a non-residential property made after a building is placed in service, interior improvements to a residential property made after building is placed in service, landscaping improvements only. Again, you do not have to get this answer correct, but please respond. We need you to respond to 3 of 4 polling questions in order to be eligible for CPE credit. Okay, it looks like B is the prevailing answer, and we've received 133 responses as of now.
Great. So I have a question in here. I'll go ahead and answer that. Should building components, site improvements, and building structure match purchase price in the calculation? Yes and no. Yes, you should be able to tie out that purchase price to the actual study, excluding certain costs that aren't capitalizable. But in general, yes, it should tie out. And The only exception to your list here is land. We have to make an allocation for land as well. So building components, site improvements, building structure, and land. And all those things should tie back into your basis, your depreciable basis. Except for land's not part of your depreciable basis. You should be able to tie that back to your purchase price. So let's talk a little bit more about why these studies are, one, supported by good tax law, and a quality study is not something you should worry about, even if your deduction is 50% of your price. So 1942, we had IRS Pub 973, and this is a little bit before my time, but and most of that ruling isn't relevant anymore, but it is helpful to understand this idea of a difference between composite and component methods for depreciation. Composite, the electrical system is all part of one unit of property, and component, we're saying, no, well, these decorative lights aren't necessarily part of the primary lighting system. And so that was the first time the IRS there was a publication saying that we were allowed to make those determinations between those types of assets. 1975, this was a huge one. Whiteco Industries versus Commissioner. I'm going to talk about this one more in a minute, but this was permanence. Is that asset inherently permanent to the building, or is it easy to remove? Let me come back to that. Now down here, Scott Paper versus Commissioner, 1980. That's what I'm talking about when we talk about composite and component pricing. That allowed us to do load analysis. Think about those data centers. And this was later solidified in 1986 by Illinois Cereal Mills. I think in the Illinois Cereal Mills case, they were allocating 70% of the electric or some ridiculously high percentage, but basically because they did an actual load analysis, they factored out how much of that electricity is going into machinery versus base building. That was justifiable, and that's a well-established practice in the industry today. So 1990 Morrison, we got improvements, decorative or base building. Again, if they're decorative, they generally qualify. If they're something required to be part of that building, like the slab, then they're probably 1250. 1997, long battle for these guys before my time. We get Hospital Corps of America versus Commissioner. This one was the landmark case. This is what made, this is what's buying my house basically today. The tax court determined it was Congress's intention for taxpayers to distinguish between components that are 1250 and 1245 property, going all the way back to that composite and component pricing. In 1997, we finally got case law saying that this thing was okay. And of course, it took the IRS 2 years, 1999, to finally acquiesce to the validity of this. But 1999, that's kind of our year where cost segregation became a irrefutable service that we can provide to our clients. And of course, 5 years later, the IRS came back with an audit technique guide and said, this is how we're going to audit these things. This is how we're going to look at these assets. And in general, it's pretty good. It's not perfect. There's things that a lot of practitioners don't agree with, myself included. They have updated it a few times. And you can't cite this thing in tax court. So I think the IRS is aware of that as well. But it is a good starting point. It's a good document to be aware of, as long as you understand the nuance and the other rules behind this thing. Let me look. We have a question here. Do you have a benchmark for land allocation, i.e. 20%, or is it based off market and dollars per square foot? Yeah. So the IRS doesn't like just throwing 20% at a land allocation. Generally, the best thing you can get is an appraisal that offers a land value that says, hey, we've basically come up, we've looked at comparables, and we've determined this is what we think your land value is. If that's not available, you can usually use the assessor. You can use a percentage between land and building and make that allocation that way. And if you don't do it that way, the IRS, there's not a hard and fast rule about what you're allowed to do and not allowed to do. You should be consistent across your portfolio of buildings, and you should, sorry about that, and you should be consistent across your buildings, and it should be fact-based. Okay. And if you do those things, it might be a defensible method, but it's not just an appraisal, and it's not just an assessor. Although I will say 95% of what I see, it's one of those things. It tends to be the the defensible method. So we'll talk about a few more changes, and then we're going to get out of history, I promise. As fun as it is, I know everyone's excited to be here early in the morning. 2011, we got those tangible property regulations proposed. That allows us, to look at routine maintenance, safe harbor for these repairs. We start talking about dispositions and what does that mean. And in 2014, those were finalized. 2016, the PATH Act. This is kind of more when I started getting into the field. We got qualified improvement property, and of course, this wasn't fully defined yet. At that point, we had 50% bonus depreciation, and it was still only available to newly first use buildings, right? And then 2017, we got Tax Cuts and Jobs Act. This is where we got rid of that qualified leasehold improvement. We got rid of qualified restaurant property, qualified retail improvement property, and we got a true update to QIP and what it means. But we introduced the retail glitch. Some of you, I'm sure, remember this. All these interior, non-residential, non-structural components were now eligible for QIP, and 100% bonus was available to everyone with a tax life under 20 years. But QIP was 39 year, and it was clear that wasn't Congress's intention. It was clear to us as practitioners that wasn't what it was supposed to be. But that's what it was for 3 years until 2020 when we got the CARES Act, which finally fixed that retail glitch and moved QIP back to 15 year. Well, to 15 year where it belonged, where it was intended to be. Did I miss a question here? No.
Did you get the one about the benchmark for land allocation?
I addressed that one.
Okay. I think you're caught up then.
Okay, yeah. Let me speak to this one. If you build a rental property and have detailed records of the cost of every component, do you still need a cost segregation study? You do if you're not, if you don't have experience with cost segregation. That's what I would say. A lot of experienced people have made a lot of mistakes doing this. There is a ton of nuance. I'm going to go into a case study at the end of this, which is going to kind of illustrate some of that. But I would say you do, unless you're really good at the nuance of qualifying property. And if you have detailed cost records, you're going to get a higher benefit when you do your cost segregation study. The more detail you give us, that usually, I can use that as ammo to justify more deductions. So let's talk about these tests. Appearance and function tests. We have a case called Consolidated Freightways versus Commissioner. And basically that question was, does the structure look like a building? Does the structure provide workspace that is more than incidental to the primary function of the building? And in this case, we had a company, Consolidated Freightways, they were arguing, we have a dock and this is really more for loading and unloading materials. It was attached to a building. We think that this is more of a land improvement. It's not really part of the base building. And the IRS obviously disagreed. So what they argued was, and I think I have my definition here to look at next. I do not. So what they argued here was, a building typically has 4 walls. It typically has a roof. It typically has doors. This dock doesn't really have that. We have a slab and it was covered by a roof, but other than that, they said it's really not a building. This is more just for loading and receiving. But did it look like a building? I mean, kind of, yeah. And did it provide workspace that was more than incidental to the primary function? Unfortunately, the court did see it that way. I mean, this space was for workers to work on, to receive and unload and load materials, and so they determined that was part of the structural part of the building. Now, we're going to talk about 3 tests, 2 concepts. First, though, is the functionally no more than incidentally related to the operation maintenance of the building. That's the first category I like to talk about. And that's that accessorial test. That's the first test. Is this really part of the base building, or is it more accessorial? And actually, I think we're going to talk about this more in a second. Again, you're the first one seeing this slideshow, so pat yourselves on the back. We're making history here. Then we get our sole justification test, and there's 2 concepts buried in there. Again, these aren't hard and fast in tax law, but they have informed a lot of decisions over the years. And then our favorite test in cost segregation, the not inherently permanent test. Again, we can't rely on this exclusively, but it is a very important test nonetheless. And I'm going to go into that in our case study toward the end. Accessorial. Is that component required for the normal operation and maintenance of the building? General lighting, plumbing, HVAC, fire suppression? Yeah. We're probably not going to get away with that. That's going to be part of the base building. That's most likely 1250 property. But if that's supporting a specific business function, if it's running that data farm, if it's electrical, that's for that equipment, if it's those nitrous oxide piping, or even if it's a dedicated water heater. Again, this has to be a dedicated water heater in a kitchen. No 1250 water, as we say, nothing going to a bathroom. But if it's literally just serving your dishwashing sink, we might be able to qualify that. If those are gas lines that are only supporting restaurant equipment, we can probably qualify that as a short life. So that would meet the accessorial test. When we look at sole justification, sole justification really kind of applies. Like, remember, we had the load analysis for electrical. Sole justification really applies mostly to these HVAC. And here, the Piggly Wiggly was a grocer in the South, and what they had that was allowed in this case because it met this, it's only for the needs of the business. They had these HVAC extraction fans. I've been wanting to try this thing, and I think it's going to work. There we go. That's these guys right here. The point of those, this is a cooler that's underneath it. So the point of those is that is actually pulling moisture and humidity out of the air so that the floors don't get wet and people don't slip. Now, we say, would that building need that if this wasn't a grocer? What if we turn this into a distribution facility? No, it doesn't need those extraction fans to be that. It only needs those so that cooler can be there. So we would say that meets the sole justification test, and we would be able to qualify that. Now, HVAC in general does not qualify, but again, there's an exception to everything in tax, right? So we see HVAC qualify in buildings like supermarkets, cold storage facilities, or even if you have an IT server room where you're just running a bunch of server equipment. If you have a dedicated HVAC in that room, it probably qualifies. So let's talk a little bit about the unitary concept. Again, these aren't like hard and fast codified rules. They're more like the historical rules that informed these tests that we just saw above. The unitary concept. Can this building function without that component? Obviously, if we remove a passenger elevator, we're going to have to do some pretty major renovations. We're going to have to close that off or do some other thing for the building to function normally. It's going to at least have to have a stairwell and pass safety regulations. So those generally don't qualify. But when we think about an overhead door, a lot of those can be operated by a chain. A lot of those don't need that motor. So we would say that motor isn't necessarily part of the unit of property of the door. It's separable. It's also non-permanent, which we're going to get into next. So in general, we consider these overhead door motors to be 1245 property, and that we can move those to a shorter life. Now, incidental use test. This one's a little weirder. Again, we're talking about whether components are necessary for general operation. That primary electrical, it's probably 1250. The building has to have lighting. The building has to have even fire alarms, and it's how the IRS has seen that. But things that are related to that cold storage facility, maybe you have laminar flow clean rooms or something in your high tech building. Any electrical or HVAC related to those processes, as long as it can be identified, as long as it can be proven, documented, and the cost of it quantified, then we can usually allocate that to 1245. Again, this isn't a specific test. This is more informed that accessorial test and that our ability to qualify any of these types of property. Just let me know when I need to stop, and if we need to do another poll.
Now is a good time. Let me
All
get
right.
it set up. Let's see. Okay. What is the White Coat criteria? Excuse me. The White Coat criteria relates to whether an asset is accessorial to the business, residential or non-residential, qualified improvement property, inherently permanent. We're off to the races.
I mentioned this a few times a second ago, but I haven't specifically covered it. It was on a slide a second ago, though. Again, you don't have to get these right, but it's going to lead right into what we're going to talk about here in a second.
That's right. We need, we're only at about 54 responses. Okay, here. Starting to cook. Let's see, it looks like accessorial to the business is the prevailing answer.
No, actually, it is inherent permanence. That's what Whiteco is dealing with. And again, we're going to talk about that a little more depth here in a second. I think I have a couple questions. And I think I'm getting close on time, so let's do them quickly. If you build a rental property and have detailed records of the cost of every component. Okay, we covered that one. Is it more beneficial in a self-rental commercial property to have the improvements made on the real estate owner entity level or the tenant operating entity level? So I guess you're talking about if maybe if we have a pass-through entity, and in that case, I think the benefits generally flow through to the owner either way. So I don't know that it would be more beneficial or not. That would be something I would either ask my tax partner or refer back to you CPAs. Actually, I don't think it's more beneficial. No, I think if you're a pass-through entity, it doesn't really matter. And then if you're non-pass-through entity, it really comes down to which tax return do you need it on? Where do you want to park those assets? And that's a bigger discussion.
There's a question in chat. Would a second AC unit in a residential home be eligible? A residential rental property specifically?
I'm going to say most likely no, unless you've got some process in the garage that it's sole justification. Again, HVAC, we like to look at sole justification. If it's for human comfort, it's not going to qualify, unfortunately. But if it's for machinery, if it's supporting the business activity in that building, then it might qualify. Yeah. So let me move forward. As promised, Whiteco criteria, the permanent assessment. This one I am going to read right off the slide, just because it's a little redundant, but this is how it's worded. Can the property be moved? Has it in fact been moved? How difficult is removal? Is that removal time consuming? Are there any circumstances that show that intended length? How long are we going to leave that thing there? Is the property designed to remain permanently in place? How much damage will the property sustain upon removal? And then finally, how did we physically attach it to the land? Okay, so I think we did just answer the question about the AC unit in a residential home. We can come back to that at the end if we have time. So let's apply that test. Let's go in and look at what this thing looks like out in the field when we're really talking about these tests. And we have a definition of a building. That's going back to consolidated freightways. Any structure or edifice enclosing a space within its walls, usually covered by a roof, the purposes of which is to provide shelter, housing, or working space, office, parking, display, or sales. Again, we say in general. A lot of parking garages don't have roofs. A lot of buildings like a dock, and I'm not saying no dock qualifies. Again, there's always exceptions, but a dock doesn't typically have walls. It might not have a door. But this is the regulation general definition of a building. So it tends to be a good starting place when we qualify assets, especially convoluted or complex assets. This is an actual building I looked at. It's an actual object I looked at. You'll see there's a primary building here and a primary building here. And there's a fun fact as we go through it. They filmed part of Walking Dead on this site. But this is basically a tent that they put up over this old slab. Does this appear to be a building? Kinda. It lacks a lot of normal structural components that we see. It's light metal framing. There's some lights in there, sure, but they're string lights. They're just kind of hung up. The roof and walls are a single component, right? It's not multiple steps going into that thing. It's not asphalt on top of a membrane or something. It's flame retardant vinyl is what it is. And then at the end, it's bolted down to the concrete below it. And that slab was not poured for it to be there. That's a 100-year-old slab that's been there. It's been not used for 30, 40 years. Does that structure function as a building? Yeah, that's not great. It does provide workspace. They're staging, loading, unloading, and doing some other commercial activities inside here. So we don't do great on the appearance and function test. Maybe we can do a little better when we apply the White Co criteria. Can we move this thing? Absolutely. It's a light metal frame. It's bolted to the ground. The roof and walls, single vinyl cover. That lighting, as I said, is string lighting. There's really not a lot of evidence here that this is going to be here forever. Would it be difficult or time consuming? The owners built a couple of these. His crew, it originally took them 10 days the first time they did it, and then they got to where they could put these things up in 2 days, and then they could take them down in 2 days. So I would say we passed that difficulty in removing, that time consuming question. Is the property designed or constructed to be permanent? No way. This slab was not poured here for this thing. This thing is literally bolted down to the ground. That's 4 bolts is one of the, or 8 bolts, I guess, is one of the primary structural supports. So, and this thing was manufactured to be able to be moved. Is there any circumstance that shows how long they're going to be here? In this case, the CFO told me that the owner, he likes to move these types of assets around. And we can see here, it's not necessarily custom, it's not a custom built, but so much for this building. We've got an overhang here, that we've got the vinyl roof hanging down on the edge, right? So there's some evidence to show that this thing has intention to be moved. And in fact, the CFO was representing that they do intend to move it. So I'm inclined to believe it could be. Now, will it sustain damage? No. As I said, this is made by a company who makes circus tents, right? These things are meant to be moved over and over and over again. How do we attach it to the land? It's attached at the bottom with those bolts that we saw. And then up here, you can see this is actually a piece of sheet metal that they put in here. And they just bolted that one to the building and then to the structure. And that didn't even come with this thing. That's something that the owner just did. And then they laid this on there, this vinyl tarp where they didn't attach it. And then further down, you can see they just put bricks on it. So in my opinion, there's a lot of evidence here to show that this thing is non-permanent. So that's one of the nuances you get into. We don't necessarily pass appearance and function, but we really do seem to pass this White Co criteria test, this permanence test. And so that's where you really need to document these facts and show that you did these tests and be able to answer these tough questions when they come back. A fly-by-night firm is not going to be able to do those things. And let me go back to this. I will say I came back the next year. I came back a year later, and they had built another one of these things, exactly the same type of tent, exactly the same between 2 buildings. And there was a dusty activity that the locals had complained about. I think they were sandblasting something. And so the city made them hang permanent fire suppression equipment in there. And because the ground wasn't really level, they built permanent concrete footers 2.5 feet tall to make this thing function. And so now we get into, this one doesn't qualify. And so really understanding those nuances, this exact structure 1 year qualified, and then basically the exact same structure didn't qualify. Now, what's the timeline look like when you want to have one of these things done? We typically say, it's about 6 weeks to get it all the way back. We get our proposal from you in the first week, and we get the EOB back to you. That's the estimate of benefits. That can be quicker. So a lot of times that can be 1 day, 2 days. And then we're requesting and receiving data. We're scheduling with your contacts on site or your client's contacts on site. We're making sure we have access to all those tenant suites. We start looking at your drawing. We start doing estimates and putting that together. And then we do that site visit. And that's really kind of the holdup that adds that 2 to 3 weeks is we have to get the thing scheduled. We have to get it scheduled with the tenants and all the stakeholders on site. And then we have to actually go see the thing. After that, we compile the report. It gets peer reviewed. There's 3 levels at our company. We have our peer review. Other senior people come in and look at what you've done. Then it goes to a senior management review and finally a final review. I'm sure everyone here has been through enough reviews to understand that process. And then we deliver it back to you, to client CPA, and we give you a window to review that in. And if there's anything you want to talk about or be able to better explain to your client, then we take the time to do that for you. Now, this is a little bit easier way to look at that, I think. We get, the pre-qualification. We're in that first stage. We're defining the scope, getting you that EOB, making sure that the thing makes sense before we engage you. right? Making sure that we have a good understanding of the project and that you have a good understanding of what your benefit's going to be and what the cost will be. These things should always be fixed fee. The IRS doesn't like incentive for us to drive the benefit up. So any reputable firm will be working on a fixed fee. And then we request and gather that data, your cost, your construction detail, everything you spent. We're requesting plans that you may have, appraisals, working with you to get that land value allocation. We actually do the study. We review the report, issue the final report, and sometimes we make revisions if there's a lot. You'd be surprised how many times additional detail comes to light when we give it back. Oh, we spent another $200,000, and as long as that's reasonable, it's easy for us to revise that. And then finally, a year, 2 years down the road, when the IRS comes back and wants you to give your deductions back, we're there for your audit support. Anyone doing a reputable study should be able to explain all the deductions in their report, just as we went through above with that tent, right? That could be a complex asset, and if you don't know those tests, most likely you're either going to say, yeah, it all qualifies, or no, it doesn't. But that's why you would want a quality firm to do your study, because the IRS is going to challenge things. With that ATG, I have another CPE coming up in a couple of weeks where I'm just going to talk about some of these crazy things the IRS has been challenging, because CPAs and owners don't know the nuance of these tests, and they like to come out and say, oh, well, what about AmeriSouth? AmeriSouth it says this, but there's a ton of problems with that case, and if you don't know the history behind it, you're going to say, okay, yeah, I guess you're right, and you're going to give it back because they're going to point at the ATG and say, well, look, we said we can, it's not qualified right here. But that decision was again 13 years ago, and it's still never been back to court. And there's a reason for that, because we all want them to go back to court, and we want to be the one to defend it. At least, people who know what they're talking about.
John, we have one more polling question we need to get in.
Let's do it, and then I'm going to read over these questions that we've got.
Okay, here we go. What is the primary objective of a cost segregation study? A, increase property value. B, accelerate depreciation deductions. C, reduce building maintenance costs. Or D, improve tenant retention. This is the last of 4. Just to reiterate, you do need to respond to 3 of 4 to receive CPE. That the other qualification is 15 minutes attendance, and we're just over that now. And it looks like we have a majority who say B, accelerate depreciation deductions.
That's right. That's the name of the game. Present value, right? That's our dollar today is worth more than a dollar tomorrow. That's correct. Let me get to a few of these questions. Is there a general cost to expect for a cost seg study? You're right. It depends on the industry. We have very competitive pricing. I would say it typically it can go as low as about $3,000 for a single family home, maybe an Airbnb, but you're going to see an ROI usually of greater than 10 to 1. And these things can be any amount of complex. I've worked on a couple close to $1 billion properties, and those are highly specific. It involves the complexity. I just looked at an arena where they have moving screens on the stage, and they have several hotels on site. It's a whole huge resort, and obviously the price can go much higher. But the ROI on cost segregation is typically really high, higher than you'll see in a lot of other tax incentive industries. What was the life of the structure you used for an example in the category of the structure, if not a building? Well, basically we considered it equipment. It was a 5-year asset in that case, and the reason, and you can make an argument that it was 7, or you could tie it to a specific manufacturing class. But we assumed it was short life, 1245 property. Now, in the same example, when they hung those permanent fire suppression equipment, now we don't pass the test where was there any intention to move it? Probably not. By the time you go spend $100,000-$200,000 on a fire suppression system, right? So it's both. It depends on the facts. In the first example, yeah, it's 1245, and in the second, it's 1250. In my opinion, and that was something we fought about internally quite a bit. But Can source assist with audits to support depreciation taken in prior years? If we did your cost segregation study, we will absolutely support the audit. Unless for some reason, there's always an exception in tax, right? Like we've had engagements where we talk about that up front and we're like, listen, this is going to be like, we did one for a Puerto Rico tax law. We're not going to be able to help you with that audit support, right? I did one in the UK, and that's going to end up going through our UK branch. So yes, we assist with audits to support depreciation taken in prior years. If you're talking about something that we didn't do a cost segregation on, reach out. Let's have a discussion. Those are case by case, facts based, and we'll see if we can find a solution for you. Oh, I got one more. How do these depreciation deductions provide benefit when it is owner-occupied commercial building? Okay, well, so the personal use problem is really only for your primary residence. Owner-occupied commercial building, assuming you have basis and whatever you have basis in can qualify. Really, if you have basis in the bricks and sticks, the actual structure of that building, then that can qualify. We can reallocate a portion of that. And if you have basis just in the finishes, just in the carpet, the break room, maybe you built out the office space or you added a lot of electrical for your manufacturing activity. All those things can qualify, and we can definitely do a cost segregation study on one or both of those things. Will you please discuss the difference between using a calculator cost seg versus an engineering cost seg? Yeah, there's no site visit, right? We never actually went to the site and with a calculator cost seg, we didn't prove that those assets existed. Even if we did a virtual site visit, the owner could have gone to the building next door. And if it's a similar looking building, you might not know, but the finishes and the qualifiable property might not be the same. So the problem with doing a calculator cost seg, and the reason the IRS doesn't like them, is because it's hard to prove that, one, the owner represented the building correctly. The IRS is I've never seen them actually go back out to the site. I've heard that they will sometimes, but they're going to disqualify your study. One, if you haven't taken pictures, if you haven't documented these things well, if you didn't use common nomenclature, standard numbering system, if you didn't use a reputable way of assigning cost to these things, if you didn't assign an obsolescence factor, if you didn't consider the soft costs or the your engineering, your architectural, if you didn't make all these considerations, or if you don't have tax law to back up what you did, they're going to disqualify the whole thing. And basically you went and bought a calculator for nothing. So when you use a cost seg calculator, basically you're swagging it. You might as well just throw 20% on 5 year and call it a day. I don't recommend doing that, for the record. That's going to get disqualified. That is not a recommendation to do that. You should have a cost segregation study done if you want to get these deductions qualified.
John, we just have a minute or so left. There's a question. Do you prepare the 3115 if needed? Yes,
we can do Form 3115 and calculate your 481 adjustment. That, for anyone who's not familiar with those, those are look back studies. That's when you have a property that was placed in service several years ago. Then, as long as that's a method change, right? We look at your depreciation schedule and the amount of depreciation taken, and then we look at your new depreciation with the amount that we've increased. So like we've moved 20% to 5 year, and your 3115 will have your 481A adjustment, right? So that's the amount allowable versus the amount already taken, and that difference between those two is your additional benefit. And I think maybe I missed another question on here.
I think somebody had a follow-up question.
Okay, let me see here.
Or maybe not.
I want to make sure I'm on the right thing here. So, how should a single-family rental properties be held to best take advantage of the cost segregation, i.e., in a trust or an individual's name? Wow, that's a complicated question. I mean, that comes down to your tax strategy and your tax goals. I would say most people tend to hold them in LLC, maybe some kind of S corp. but we see all types of ownership structures. Unfortunately, I can't speak fully to that question, but we could definitely have a conversation about your specific need. Did I get this one?
I think you've answered them all.
Okay.
If we haven't, we will do some postmortem and make certain to circle back with you if we didn't get to your question. But thank you, John.
Thank you. Appreciate everybody coming out. Hope you learned something.